Hi, I'm Susie Rhodes with Past Masters. In this video, I want to show you some information provided by FINRA. So if you go to the finra.org website and you go to SIE Exam, this is information that they want schools to cover as it's related to what somebody needs to know to pass the SIE. Now, my job is to make sure you pass your SIE exam on your very first attempt. Of course, Past Masters has an entire course dedicated to this. How do I know what to include? Well, FINRA tells us what you need to know. So would I like you to be a student? Of course I would. I'm not going to lie. But I also want to point out that if you go over this information, it is going to be very clear to you what you are comfortable with and what you might need to study more. So let's look at it together. So FINRA breaks down the content outline, which is written in 4 separate sections, into lots of different what they call sessions. So you have to feel comfortable with market structure. So you need to know the primary, secondary, third and fourth markets. You need to know the participants in those markets. You need to know about regulation. So various regulatory authorities. Who oversees the entire industry? Well, that's the SEC, of course. We also have the Federal Reserve, the FDIC. We have FINRA, which is an SRO, which stands for Self-Regulatory Organization. The MSRB is also an SRO, and so is the CBOE. NASA is the North American Securities Administrators Association. So they write the Series 65, 66, 63 exams. You need to know a little bit about federal securities law. So there's the Securities Act of 1933, the Securities Exchange Act of 34, and SIPC. You have to know about the products that are available for your clients. So equity and debt securities. So equity, common stock and preferred stock. There's also treasury stock, which is when the corporation goes into the marketplace and buys back its own stock. Done most of the time because they got lots of extra cash on hand and to drive the price up, because the law of supply and demand says the less of something, the higher the price. Outstanding stock in the hands of the public. Rights of inspection, ownership, right to vote. Common stockholders have the right to vote. Oh, you have to know a little bit about options. Derivative securities, calls and puts. Rights or short-term options, good for up to 30 days. Warrants or long-term options attached to bonds, good for up to 30 years. Par value on a bond, $1,000. The coupon rate is the nominal yield. It's the annual interest. It's a tattoo on my chest. It's not going to change ever. You need to know a little bit about accrued interest. Bond yields. We have current yield, yield to maturity, and yield to call. They always move in the same direction. It is interest rates that move the yields. If interest rates go up, the yields go up too. Price goes down. They're inversely related, price and yields. Some securities are callable. Some securities are convertible. And yield. Current yield on an investment is annual income, which would be dividends on a stock divided by current market price. On a bond, it would be annual interest divided by current market price. So current yield. They could also ask you about investors' yield, which would be the annual income divided by whatever the cost basis is. What did the investor pay for the security? They'll want you to have an understanding of investment returns. Dividends are never guaranteed, may be paid up to quarterly. Yield to maturity and yield to call, that has to do with a bond. They move in the same direction. Some bonds are callable and some bonds are not. Unrealized gains, those are never taxable. Only when you realize the gain will taxes be owed. Under current tax code, if it is a gain for a security that was held for a year or less, it is taxable as ordinary income. A year and a day or longer, it is taxable as a long-term capital gain. The record date is the day your name needs to be on the books and records of the corporation in order to receive the dividend. The payable date is the day that it is paid. Cost basis is how much after-tax dollars are in an investment. Return of capital, if it is a after-tax investment is not taxable. If it's a qualified retirement account, for example, your cost basis is 0. So you have nothing in there that's been taxed yet. So be careful. Benchmarks and indices. The narrowest index is the Dow Jones Industrial Average, 30 large cap stocks. The broadest index is the Wilshire 5000. So sometimes we have an index fund, like an S&P 500 large cap index fund, where if you're an investment advisor to an index fund, your job is to mirror the index. Sometimes we use indexes as benchmarks, where the investment advisor's job is to try to beat the index. So various ways we can use those. Packaged products and options. Types of investment companies. So under the Investment Company Act of 1940, there are 3 types of investment companies. There are face amount certificate companies, unit investment trusts, and then these are what we call management companies. So the 3 types of investment companies: management companies, UITs, and face amount certificate companies. Management companies, mutual funds or management companies. Mutual funds can be open-end funds or closed-end funds. Open-end funds are always new issues. Closed-end funds sell new shares one time, and then those shares trade in the secondary market. So management company, one of the 3 types of investment companies. You need to understand what is net asset value. You need to understand what a pooled investment is, like a mutual fund. Sales charges. There's different classes of shares. Commonly for the test, A, B, and C are all you really need to know. There is institutional shares as well. Breakpoints are available, may be available. You'd want to read the fund's prospectus. A letter of intent is good for up to 13 months, has to do with getting a reduced sales charge up front. The right of accumulation is once the account balance gets over the breakpoint, there's a reduced sales charge. Strike price, premium. Wait a second here. What is this? So within this packaged products, we also have options. So we have derivative securities, calls and puts. Options can be on equities or on indexes. So the strike price in the contract, the premium is the cost of the option. An option is in the money. Depends on if it's a call or a put. So if we're talking about a call is in the money if the market price is above the strike price. A put is in the money if the market price is below the strike price. Call up, put down. When an option is in the money, that means that the owner of the option can exercise the option. When you buy a call, you pay a premium for the right to call away shares at the strike price. When you buy a put, you pay a premium for the right to sell your shares at the strike price. The seller of a call has sold an obligation to sell shares at the strike price. The seller of the put has sold an obligation to buy shares for more, the strike price, than they're currently worth. Out of the money means that the owner of the option cannot exercise the option. Options can be used to hedge or as speculation. The Options Clearing Corporation guarantees all listed options. We learned the types of investment companies: management companies, UITs, and face amount certificate companies. Which one is going to have or may have an investment manager of those 3? Management companies, just like it sounds. Variable contracts and municipal fund securities, another area session 6, FINRA calls it. Understand the basics of tax implication and suitability regarding variable annuities and municipal fund securities. Knowledge of restricted use of plan assets. So oftentimes, most commonly, annuities are going to be sold to supplement someone's retirement income. A big fear in retirement is outliving your money. An annuity, once annuitized, pays you a dollar amount monthly for life. If your client is conservative and wants to know exactly what the annuity is going to earn, then they want a fixed annuity. You don't have to have a securities license to sell a fixed annuity. A variable annuity has no guarantee as to rate of return, but historically, the stock market has kept pace with inflation. You must have both your insurance license and your securities license to sell a variable product. When they're paying money into their annuity, they're in the accumulation period. Once they annuitize, they're in the annuity period. So they have accumulation units during pay in. They can take a partial or full withdrawal during pay in. Once they annuitize, they have annuity units. No longer can they take a partial or full withdrawal. Tax advantages of annuities, they are tax deferred. So you're putting money in. We're not in a qualified plan in any way. We're just in a normal annuity. Putting money in after-tax dollars, and the earnings during the accumulation period are tax deferred. Local government investment pools and Section 529 savings plans. So when your client has children and wants to save for college, the most common way to do so today is through a 529 plan. They vary by state. There's different administrators, usually different mutual fund companies in different states. As a general rule, for all states, the money that goes into a 529 plan is in after-tax dollars. The earnings are federally income tax-free when used for educational expenses. How much you can put into a 529 plan in any given year is 5 times the current gift tax exclusion amount. And then if, let's say, grandma did that for her grandkids, she can't give those grandkids any money for the next 5 years. It is true each state is going to have a different account balance that a 529 plan can get to before they're going to say no more money can come into this plan. Some states, the money that goes into the 529 plan is tax deductible, but each state has different rules as far as this goes. So for the real world, be sure to know your state's rules for 529 plans. For example, some states require the money stay in the state. Some states don't care. Some states have a limitation as to how much is tax deductible. So if you put in $20,000 and the tax deduction is only $4,500, you want to be aware of that so that you can make sure your clients understand. Alternative investments on the risk spectrum are speculative. They're risky. They're not for your everyday average client. They have to have an aggressive risk tolerance to be suitable for your clients. Direct participation programs are illiquid. There is no secondary market for them. Exchange-traded funds, those are pretty popular. Exchange-traded funds are like mutual funds that trade in the secondary market. Oftentimes they're index funds, but not always. They can be actively managed. So by itself, an exchange-traded fund is on the aggressive side of the risk spectrum simply because it's equity. But there are types of exchange-traded funds that are riskier than others, like an inverse ETF, which attempts to return the opposite of the market, or a leveraged ETF, which attempts to return a multiple of an index. Both of these are only good for one day, short-term, high risk, not for everyday average clients, where ETFs are very, very popular. They're tax efficient. They are easy to get in and out of. If you are a limited partner in a partnership, which direct participation programs are usually organized as partnerships, it is a passive activity. If you have a loss, it can only be written off against other passive income. If you have securities over the year that you've sold and had a gain, and you've had some losses this year, you're going to net those together. You can write off up to $3,000 under current tax code against your ordinary income. DPPs are illiquid. Exchange-traded notes are not equity. They represent debt. Hedge funds, not good for everyday average clients. You must have a certain amount of money to get into a hedge fund. They engage in riskier investment philosophies within the portfolio. A REIT is like a mutual fund, but instead of having securities in the pool, there is real estate. Some REITs are publicly traded and some are not. If they're listed, they would be more liquid than an unlisted REIT. An unlisted REIT would have a higher level of risk. Offerings. Session 8. The IPO is the very first time that the shares are traded. The securities trade the very first time in the primary market, in the issuer market. The broker-dealer, investment bankers, the syndicate is going to form and put together the paperwork with the help of the issuer, of course, to file with the SEC. So we have regulatory filing requirements. The SEC has to clear an issue before it can be sold. It is possible when the regulatory filings are done that some of the shares are going to be sold now and some are going to be sold over the next few years off the shelf, they'll sometimes say. Public offerings are IPOs. Private securities offerings are not made to the general public. Perhaps a Regulation D offering, which is SEC Regulation D, the Federal Private Placement Rule. Economic factors and investment risks. Diversification is always important. Having lots of different company stocks. You can even diversify by asset class. Have some stocks, have some bonds, have some cash, have some real estate. Gross domestic product is the value of goods and services produced within a country's borders. Gross national product has nothing to do with location, has to do with nationality. So if an American business is overseas, the value of goods and services produced overseas is included in GNP, not in GDP, because it's not within the borders of the United States. Monetary policy, the Federal Reserve is in charge of monetary policy. So interest rates, there's the federal funds rate, there's the discount rate. They also buy and sell securities through the Federal Open Market Committee. Fiscal policy is budgetary, changes in tax laws. Open market operations, that falls under monetary policy. Exchange rates are going to play a role in our economy. The business cycle, expansion, peak, contraction, trough. 4 phases to the business cycle. They always go in that order. How long is one going to last? We don't know. We'll look at economic indicators to determine which phase of the business cycle we are in. There are leading indicators, there are coincident indicators, and there are lagging indicators. Leading indicators show us where we're going. Coincident indicators show us where we are. Lagging indicators take a while to reflect what's currently happening. So they're not going to change until after the fact. How do we mitigate risk? Well, diversification. We can have strategic asset allocation. Strategic asset allocation is subject to the need to rebalance. We can also hedge our portfolio. Some investments are more liquid than others. The closer they are to cash, the more liquid they are. Some investments are a hedge against inflation. Gold, risky, speculative, but often a hedge against inflation. Equities, a hedge against inflation. Fixed annuities have inflationary risk. Cash has inflationary risk. Bonds have a fixed interest rate. They have interest rate risk. Reinvestment risk is when an investment reaches maturity, like a bank CD has reinvestment risk. Trading, settlement, and corporate actions. Most of the orders that come across the floor of the exchange are market orders, but there are also what we call stops and limits. Loss helps us remember the orders that are below the current market price, open buy limits, and open sell stops. Obstacle are orders above the current market price, open buy stop, and open sell limit. So you need to know a little bit about those and how they work. Stock can be owned long, or stock can be shorted. When you short stock, you sell shares you do not own. To be long a stock is bullish. To be short a stock is bearish. If you sell a naked call, that means you don't own the shares that you just sold the call on. Very risky to be naked. If you sell a covered call, it means you do own the shares. So you only have unlimited risk when you sell a naked call. Settlement timeframes. Securities under Regulation T settle T plus 1 business day. That's trade date plus 1 business day to pay, to settle. Most securities are in book entry form today. Very few people get physical stock certificates or bond certificates. We can have a stock split or a reverse split. In either case, the amount of money in the investment remains the same. So stock splits are generally done to bring the price down. Reverse splits are done to ensure that the security remains listed and bring the price up. As a common stockholder, you have the right to vote. So you will receive proxy materials related to what is up to be voted on at the annual meeting. Customer accounts and compliance and prohibited activities. So you can have a cash account, you can have a margin account, you can have an options account. You can have an individual owner or you can have a joint account. You can have a business account, a trust account, an estate account. The account might be an IRA or a 401k, a SEP, a simple retirement account. Qualified plans are subject to RMDs, as are traditional IRAs, required minimum distributions. Under the Secure Act, RMDs are required no later than April 1st of the year after someone turns 73. Now that will go up in 2035 to 75. Broker-dealers have to follow anti-money laundering regulations. So there are currency transaction reports and suspicious activity reports that must be filed. You have to know your customer. Do not engage in market manipulation. Insider trading is bad. No financial exploitation of seniors. Improper use of customer securities or funds is also not a good idea. Falsifying or withholding documents. If you are a registered rep, can you share your commission with someone who is not a registered rep at the same firm or a firm that's in direct or indirect common control? You can only share with another licensed agent at your firm or one that's in direct or indirect common control. You will have to know SRO regulatory requirements for associated persons and employee conduct and reportable events. You will be a registered representative once you pass the SIE and a top-off exam. You have activities that you are permitted to do. If you take a job outside of your job with your broker-dealer, you must notify the firm. They will conduct a background check. They will do fingerprints as part of becoming a FINRA registered representative. You will, most of the time, need to take and pass a Series 63 and register at the state level. That does vary by state. Series 63 is a Uniform Securities Act exam. It is very wordy. Be sure to study for that one. It is a hard test, but you got it. As a registered representative, you have continuing education that is required. There is the firm element and the regulatory element. It is due annually. To apply for your license, it is Form U4. To resign your registration, it is Form U5. Any customer complaint that you receive, you must forward on to your principal, your manager. So if they call you on the phone and are mad at you, make them happy, they'll go away. But if they write you a letter or an email, you must forward that on. Potential red flags, outside business activities, private securities transactions, and the reporting of political contributions are all rules and regs that you have to feel comfortable with to pass the SIE exam. Okay, that was a lot. So by all means, that's not everything you need to know to take and pass this test. I highly recommend that you go to the FINRA website and you take their SIE practice exam. It is a really good exam. It is indicative of the level of the test, how the questions are worded. The more you practice, the better you'll do. Thank you so much for watching. Be sure to give this video a thumbs up, subscribe to our channel, and turn your notifications on. If you have any questions, I'm happy to answer in the comments below. If you'd like to check out past master's course offerings or to enroll in any of our programs, there is a link in this video's description. Thank you so much for watching. Happy studies. Study, study, study. Pass!